Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. I hope you enjoyed this interview preview with Dividend Stocks. What would you say was your biggest investing mistake of 2016, and what did you learn from that experience?
I was too conservative in February of 2016 when oil was bottoming out. Of course, nobody knows when things are bottoming out.
Sure.
But a lot of the energy stocks that I'd written about and owned were, at ridiculous prices. And had I had the benefit of, foresight then instead of hindsight now, I would have bought more of them. And instead of just, dipping my toe in the water again. So the thing about that is to expand on that is, okay, so say you bought something at $20 and then, oil crisis hits and it goes way down and now it's at $8. Are you still a believer at $8? Well, how do you figure that out? Well, you go back into the metrics and so on and examine it again, which I did. But there's also the fear factor of wondering, well, how much lower is this going to go? There's a certain amount of money in the principal amount that you don't want to endanger. So that's one of the other issues. Say, if you're an income investor who is relying on that income versus a person, let's say, in their 30s or 40s who can take a lot more risk, then you have to weigh those two factors, obviously. So I was, in retrospect, like anybody, I wished I was 20 years younger. I was able to back up the truck, when all these companies were selling for, single digits or low double digits, and that are now in the 20s and so on.
Well, tell me this, because that's one of the, I think that question applied to a multitude of different opportunities plagues me on a regular basis, and I know that's not unique to me or you in any way. That's true for all investors. The ones that got away, for example. So it's obviously easy to look back and see that, but we're all in the situation of wanting to look forward and learn from those, and hopefully take advantage of those better in the future. So it's easy for you to look back and say, "Oh my goodness, why did I not buy more of these energy stocks in February 2016 when they were bottoming?" But
that's the dark side of the internet, Brian, as well. We're all blessed because we have all this information now, right? But for every article that says go and buy it, there's going to be, one that says don't, and here's why. And, people can make very compelling bearish arguments. And so if one is already a little fearful and you read a few more bearish articles than bullish ones that can, put you over, into a corner and say, no, I'm not going to get any more exposure. I can't afford that risk. But it all goes back to, the company. Does the company have a decent business model that's going to be sustainable or not? Now, some of these stocks, they seem to be very sustainable. For example, the sand stocks, where they were using sand to increase the yields.
The frac sand.
Fracking sand, exactly, to increase the pressure and bring more of the liquids out of the ground, for example. And they seemed like they had very sustainable business models. Management was even saying, we're doing well, and so on and so forth. And we have, long contracts. Suddenly, they started reporting, oh, well, our operating income fell by 40% in this first quarter. And then later they cut out their dividends. Well, what happened to those long, multiple-year contracts? Well, they were, their big customers like Halliburton and Schlumberger were obviously, pushing them for, heavy discounts. So those long-term contracts, in that sense, didn't amount to what they should have amounted to. It's not always that way, but in that particular commodity-driven business, it was. It's different in the shipping business, depending on what commodity they're doing and the actual state of the industry itself.
So when you look back on that, what now was clearly an opportunity, but wasn't as clear then, do you look back and think, man, I saw it and I knew it, but the sentiment of everything just won out? Or do you look back and say, you know what, I really still made the right decision based upon what I knew? Like, how do you view that?
Well, for starters, I held on to all of these stocks, and I kept writing my articles, every quarter about these, LNG stocks, for example, and so on, that were just getting smashed in the market. And I kept, updating how were they doing. Well, they're doing fine. They've got really good growth and so on. And slowly, the stocks, came back.
Right. So, but you wish you would have bought more of them, as they obviously when they were down at the decline, of course.
Yeah, I did buy some more of them at the time, but it's the one that got away.
Sure, absolutely. Well, on the more positive side, what would you say was your biggest victory of 2016, and what set you up for that success?
The biggest victory, one of them anyway, was I got on to looking for obscure stocks. Some of them, and a lot of them, are traded on the pink sheets, which gives a lot of seasoned investors the willies, and rightfully so. The pink sheets can be a minefield, but they've come a long way. The pink sheets are run, and now they're called OTC or OTCBB. They're run by a company called OTCM, which has made really good strides, and they'll probably be bought out eventually by some larger concern. So in that arena, you've got some of the biggest corporations in the world that are not U.S.-based, people like Bayer or Nestle. They're listed on OTCM's website, with these listings. But then you've got these obscure ones. They all mostly have 5 letters to their name.
Right.
Right. So the way it happens is I spend a lot of time screening. I screen in my sleep now, I think, and I just keep going, screening for high dividend payers.
And what tool do you use for that? Is that an in-house tool, or do you use something else?
In-house or FinViz. I'll use some of the brokerage ones as well, Schwab. There's all kinds of ones. Right. And they don't all have, the data isn't, always that accurate, but sometimes it leads you to a place. So I, kept screening, and I found a stock called Northern State Telecom, NORSB, down in the North Carolina region. This old telecom company that started out selling the old crank telephone boxes back in the 1890s. Well, what happened was management started to turn these guys into a cloud-centered, data-driven company about a year or so ago, right? So that stock, it might trade, I forget what it was at the time, like 500 shares or 400 shares a day at the most. Some days it doesn't even trade, right?
So you put in a big order and it doubles in price.
Yeah, so I discovered this stock. It was trading at 45, and it paid $5.20 a year, quarterly dividends of $1.30. So it was yielding way over 11%. And I kept trying to poke holes in it. I couldn't. I finally wrote an article about it. And I bought some. Then I wrote an article, and I disclosed that I'm long the stock. Bought some for clients as well. And the next day, the stock went from like 45 to 60, and they traded. I think it was like 13,000 shares. Right. In the next 3 days or so, and that's the power of seeking alpha. They've got a huge following, and for small stocks that are not widely followed, they can make an enormous impact. And the funny thing is, NRSB, even with all those gains, it's still got a really healthy gain. I think it's trading at over 60 now, something like that, still yielding over 8%.
Wow, excellent.
And they've got it's a well-covered dividend and so on. But again, it's that really soul-sucking technique of screening until my eyes are closed. It takes hours and hours, and then you've got to look at a lot of frogs before you find a prince or a princess. But every once in a while, you'll find one. The other ones that worked really well was I realized that my clients' income was lumpy, and that's because a lot of the basic materials and energy stocks, the high yielders, they tend to pay in February, May, August, and November. So I wanted to get them a more even cash flow, so I started researching and writing about monthly dividend-paying stocks, and that worked very well. Not as well as the NRSB, but it worked well in that it set up a nice income stream. And the deal with them is you have some currency exchange issues because a lot of them are Canadian. However, the Canadian loonie is one of the only 2 to 3 major currencies that held up against the dollar in the past year. So that those monthly payers worked out well.
I hope you enjoyed this excerpt from the DIY Investing Summit. If you want to hear the rest of the interview and the other 24 interviews from the summit, be sure and visit DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can click any of the links in the article or show notes to this episode, and it'll take you straight to the registration page. And remember, the summit begins Monday, January 23rd. You can still register after that, but you'll miss some of the content. So register by Monday, January 23rd at DIYinvestingsummit.com, and I'll see you there. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.